Today I'm going to share with you a crazy trading strategy that will allow you to take high risk to raw ratio trades using the Fibonacci Retracement tool, and this strategy is very low risk, so you'll be able to generate profits without risking a lot of money. Now before we get started with the strategy, first of all let me show you what the Fibonacci series is and how Fibonacci Retracement works. So in order to make the Fibonacci series, what we have to do in the mathematics, we have to add the numbers, every previous number, two numbers with the next one. So if we start with a 0 and we place the 1, then 1 plus 0 is equal to 1, and then 1 plus 1 is equal to 2, and 2 plus 1 is equal to 3, and we go so on. So for example, 3 plus 2 is equal to 5, and then 5 plus 3 is equal to 8, and then 13, and then 21, and then 34. So you see, this is a Fibonacci series. By adding previous two numbers, we are making the next number, and similarly if we want to make the next number in the Fibonacci series, then the next number will be 55. Now the cool thing about Fibonacci series is that if you take a ratio of the two consecutive numbers, the resulting number will always be approximately 0.61. For example, if I take the ratio of 8:13, then the resulting number will be approximately 0.61. And if I take the ratio of 13 to 21, then again the resulting number will be somewhere around 0.61. And this number is called the golden zone or golden area of the Fibonacci retracement. This implies that whenever the market is moving either in the bullish or bearish direction, it will retrace back to almost this level. Now there are multiple retracement levels that are important in trading. So let me just go ahead and take the Fibonacci retracement tool and draw the Fibonacci retracement here. So when we draw this retracement, you see that there are multiple levels. For example, there is the 0 level, then 0.236, 0.382, 0.5, 0.618, 0.78, and 1. So all the numbers between these 0 and 1 are Fibonacci retracement numbers. And as we know, market always moves in the form of waves. For example, the market could either be moving in the bullish direction, and it could either be moving in the bearish direction, or it could be moving in sideways direction. Now what happens is, whenever the market is moving in the bullish direction, it doesn't always go towards like making bullish candle and then bullish and then bullish and then bullish. The trend always gives an impulsive move, and then it retraces back a little, and then again it gives an impulsive move, and then it retraces back a little. Similarly, when the trend is moving in the bearish direction, let me just go ahead and delete this. So similarly, if I want to draw the bearish trend, then in the bearish direction, if the trend is moving in the bearish direction, it will give an impulsive move in the bearish direction, then it will pull back a little, and again there will be a impulsive move in the bearish direction, and then again a pullback and impulsive move in the bearish direction, and somewhere at some level the trend will change to bullish, and again the market will make those impulsive moves, retracements, and then impulsive moves. Now what Fibonacci retracement does is it allows us to calculate or to estimate to which level the market will retrace back. So as we saw that during the Fibonacci retracement, the retracement or the ratio of two consecutive Fibonacci series was almost 0.61. So if we take the Fibonacci retracement tool here and draw the Fibonacci retracement from here to here, so this implies that whenever the market is moving in the bullish direction and there is the formation of this impulsive move from 0 to 1 here, then the retracement will always be somewhere around either 0.382, 0.5, or 0.618. So these three areas are the most important in the Fibonacci retracement, and whenever there is a bullish move in the market, then the retracement will be almost to these levels, and these levels are very important. And after hitting these levels, the market will again give a bullish move in the bullish direction if the overall trend in the market is bullish. So the way we trade this is we look for any key level at in the past, or we look for any key level at the formation when the market is reaching these levels. So I'm going to show you through examples. Now you know about how the Fibonacci retracement series works and what Fibonacci retracement is. Let's go ahead and talk about the trading rules for using the Fibonacci retracement in the trading strategy. So if we want to take the short positions, then first of all you want to take the Fibonacci retracement tool and you want to draw that trend, the impulsive move, either in the bullish or bearish direction. Since we are talking about the short trades, then we'll be drawing from here to here. As you can see, this is a impulsive move in the bearish direction, and then again you can see that there is the market retracement or pullback in the bullish direction. So overall trend in the market is bearish, and then here there is this pullback after this impulsive move. Now we know that this is a retracement, and after this retracement, the market will certainly move in the bearish direction. But in order to confirm and in order to take entry, what we need to do is we need to look for any key level in the past. So for example, if we go look at the past chart, we can see that at this level, there is the formation of this very good resistance where the market is touching multiple times and is being rejected. So at the same level, there is this retracement in the market, and this level is 0.32382. So for this impulsive move in the bearish direction and after this retracement, now we are expecting the market to move in the bearish direction. So the rules to take the entry would be to put your stop loss at the above this retracement level. For example, if I go ahead and take the short position, then we'll put our entry at the close of this candle, which confirms that the market is moving in the bearish direction, and then we'll put our stop loss just above the retracement, and then we want to take profit using the Fibonacci extensions. Now Fibonacci extensions are used in order to decide the take profit levels. For example, if I take the Fibonacci retracement tool and if I draw from here to here, then the Fibonacci extensions, just like Fibonacci retracements, are 1.272, 1.618 and 2.618 and so on. So for initial, we can target the 1.618 and then 2.618. You can close your trades partially using these levels. So as you can see here, all our take profits are being hit in this case here. So this is how you can take the short positions using the Fibonacci retracement tool. Alright, so now let's go ahead and talk about how you can take long positions using this Fibonacci retracement trading strategy. So first of all, again, you have to look for any impulsive move in the bullish direction. And as you can see here, from here to here, the market is giving us this impulsive move in the bullish direction. And then after this impulsive move, there is retracement in the market. Now, the harder thing is to determine whether it is a trend reversal or it is a retracement. And you can do that if the market stops and bounces back from these three levels, any of these three levels, then you can take that as retracement. But if the market just passes through these three levels, then it is not a reversal. It is not a retracement. It is actually a reversal. So in the pullback, you can see the market is reaching this 0.5 level, and after the formation of this, you can see there is the formation of this inside bar candle. So we can use this as a confirmation candlestick pattern, and the breakout from this inside bar is in the bullish direction. So we can take a long position at the close of this candle here, and we can put our stop loss at the last candle or the low of this retracement, and we can target, again, we can take the Fibonacci extension tool and draw from this level to this level in order to take the retracements and extensions, and we can target 1.618 as our primary target, and then after that we can break even the trade as soon as the risk-reward ratio of 1:1 is met. And then first take profit would be around this level, and then you can close your trade partially, and also you can target these levels for further take profit levels. So for example, you can trade close 50% of your trade at this level, and then you can close the rest at 2.618. So this is how you can take the long position using this Fibonacci retracement trading strategy. I know it sounds pretty simple, but when you are trying to apply the strategy to the chart, you will be getting confused along whether it is a bullish move in the or impulsive move in the bullish direction and whether it is a retracement. So you can use this as these levels as a reference to know if it is actually a retracement, and if there is the formation of a confirmation of again a start of bullish move after the formation of this retracement at these three levels, then you can take that move as a retracement. But if it just passes through these three levels and it does not respect these three levels, then it is not actually a retracement. It might be headed in the bearish direction all the way along. So I hope you were able to understand this from this video, how you can take the short positions and long positions using the Fibonacci retracement trading strategy, and you can also apply this strategy in your other strategies to add it as a confluence, and you'll be amazed by the results. So I hope you like this video. If you have any questions, please comment down below. I'd love to answer them. Also, don't forget to like, share, and subscribe. See you guys in the next video. Thank you.